Good evening. This is the post-market recap by AGI Era. Today is Friday, February 27th, 2026, and it is shortly after 4:30 a.m. Eastern Time. The scoreboard and technicals. The U.S. session has officially wrapped, and the price action suggests a decisive victory for the bears, with major indices retreating across the board. The S&P 500 finished the day down 0.40%, settling at 16,878.88. Technically, the index is now trading below its previous close, struggling to find upward momentum after a significant drop. This move puts the psychological 6,900 level firmly out of reach for now, indicating a potential retest of lower support levels if selling pressure persists. The Nasdaq 100 also declined, closing 0.3% lower at 24,960. The tech-heavy index, often a barometer for growth sentiment, showed resilience early on, but ultimately succumbed to broader market weakness. The Dow Jones Industrial Average finished down by 521.28 points, a more significant 1.05% drop, settling at 48,977.92. This underperformance suggests that the rotation out of cyclical and industrial names might be gaining traction. Crucially, trading volume today was elevated across the board, with the S&P 500 seeing approximately 2.88 billion shares traded. This heavy volume accompanying the market's decline implies that institutions are actively liquidating positions, lending conviction to today's downward move rather than it being a mere technical pullback. Market breadth and sentiment. Under the surface, the fear gauge, or VIX, while specific closing data is not immediately available from our sources, the broad market downturn would strongly suggest an uptick in volatility. This indicates a rise in investor apprehension, even if not yet reaching panic levels, as market participants grapple with the shifting landscape. We are seeing a clear divergence in sector performance. Money flowed noticeably into utilities XLU, which gained 1.17%, while technology XLK lagged significantly, dropping 1.60%. The spread between these two sectors today tells us that investors are favoring safety and defensive plays over growth, a classic sign of risk aversion and a potential shift in market leadership as economic uncertainties loom. The macro engine room. The primary driver of today's moves can be traced back to the bond market and broader macro narratives. The 10-year Treasury yield, while specific closing data is not available, the overarching narrative from the market points to a hawkish Federal Reserve stance and persistent geopolitical tensions. This context suggests that yields likely experienced upward pressure today. This move, if confirmed, is significant because rising yields directly increase borrowing costs for corporations and consumers, creating a headwind for growth-oriented sectors and mortgage-sensitive industries. Meanwhile, the U.S. dollar index is slightly lower today, settling at 97.61, a 0.13% decrease. However, the broader market narrative has seen the dollar strengthen recently due to geopolitical factors and the hawkish Fed outlook, which continues to exert influence on global capital flows. Crude oil is trading around $67.36, up 3.30% on the day, responding to ongoing supply concerns and geopolitical developments that continue to underpin energy prices. The AI and Tech Monitor. Turning to the leaders of this market, artificial intelligence and big tech, today saw a notable pullback in several key players. Nvidia finished the day down 4.21% at $177.11. Microsoft closed down 2.23%, while Apple declined 3.21%. Other significant movers in the Magnificent Seven include Meta, which was down 1.37%, and Tesla, which fell 1.51%. On the brighter side, Alphabet Google managed a modest gain of 1.40%, and Amazon was up 0.99%. The significant weakness in Nvidia, Microsoft, and Apple, key bellwethers of the tech sector, is notable because it suggests a broader risk-off sentiment impacting high-growth names. This could be a reaction to rising rate expectations, profit-taking after recent strong runs, or a rotation of capital into more defensive sectors as investors reassess future growth prospects in a potentially higher-for-longer interest rate environment. After hours and look ahead. Looking at the after-hours tape right now, shares of Exelon Corporation, are showing modest gains, up 0.75%, and Intuit Inc. Into is also seeing a slight uptick of 0.73%. Conversely, the trade desk, T, experiencing a notable decline, down 3.91%, indicating some continued volatility in specific tech and growth names outside of regular trading hours. As we pivot to tomorrow, the calendar brings us no major economic data releases, placing the focus squarely on ongoing macro developments and corporate news. Investors should specifically watch for any further commentary from Federal Reserve officials and monitor the bond market for signs of stabilization or continued upward pressure on yields. This wraps up a volatile week. The key takeaway for your weekend strategy is to carefully assess your portfolio's exposure to growth versus value and to monitor upcoming inflation data and central bank commentary for further directional cues. The market is clearly signaling a preference for stability, and understanding this shift will be paramount for navigating the weeks ahead. That is your comprehensive closing update. We will see you tomorrow morning for the overnight brief. Disclaimer: this podcast is not financial advice. Data may be delayed or inaccurate. Always conduct your own due diligence.